Hello, and welcome back to the Real Estate Channel. Are you considering real estate investing? Are you curious about how to calculate profitability on any real estate investment? Fortunately, it's not as complicated as it may seem. In this video, we'll break down and walk you through the key elements of real estate investment calculations and make it easy for you to understand. In our previous video about residential versus commercial investments, we have outlined the pros and cons of each property investment approach, and today we will look at how to calculate the profitability of your real estate investment, whether is it a residential or commercial property. So let's get started. The main goal of real estate investment calculations is to determine the potential return on investment or ROI for a property. ROI is a measure of how much money you can make on your investment, expressed as a percentage of the original investment. There are several factors that go into calculating the ROI on a real estate investment, including rental income. This is the amount of money you can expect to earn from renting out the property. You can calculate this by multiplying the monthly rent you collect by the number of months in a year. Operating expenses. These are the costs associated with owning and operating the property, such as property taxes, insurance, maintenance, and property management fees. Capital expenditures. These are the one-time costs associated with purchasing and renovating the property, such as closing costs, inspection fees, and repairs. Appreciation. This is the increase in value of the property over time. Appreciation can be calculated by estimating the potential increase in value of the property based on factors such as location, market conditions, and local real estate trends. Once you have all of these figures, you can calculate the return on investment by subtracting the operating expenses, capital expenditures, and any other costs from the rental income and appreciation. The result is the net income, which can then be divided by the initial investment to determine the ROI as a percentage. For example, let's say you invest $100,000 in a property and expect to earn $1,000 in monthly rent, with $300 in operating expenses and $5,000 in capital expenditures. You also expect the property to appreciate by $10,000 over the next 5 years. In this case, your net income would be $100,000, rental income $300, operating expenses $5,000, capital expenditures plus $10,000, appreciation equals $94,700. Your ROI would then be calculated as $94,700 divided by $100,000 equals 0.0947 or 9.47%. This is just a simple example, but it shows how you can use real estate investment calculations to determine the potential return on investment on a property. Of course, these calculations are just estimates, and the actual ROI will depend on many factors, including market conditions, property management, and the performance of the local real estate market. Experienced real estate investors also use other methods to measure profitability of an investment property. One such way is called capitalization rate. The capitalization rate, also known as the cap rate, is another commonly used metric in real estate investing to determine the expected return on an investment property. The calculation for a cap rate is relatively simple. You divide the net operating income, the rental income after operating expenses have been paid, by the current market value of the property. Here's an example to help clarify. Let's say you're considering buying a rental property for $1 million and the estimated net operating income for the property is $80,000 per year. To calculate the cap rate, you would divide the net operating income of $80,000 by the market value of $1 million, which gives you a cap rate of 8%. A higher cap rate indicates a higher return on investment, while a lower cap rate may suggest smaller return with a higher risk. However, it's important to remember that cap rates can vary widely between different markets and properties, so it's always a good idea to consider other factors when evaluating a potential investment. We hope this explanation of real estate investment calculations has been helpful and easy to understand. We wish you good luck and success with your real estate investments. As always, thanks for watching today's video. We hope you found it informative and enjoyable. If you're new to our channel, be sure to like this video, hit the subscribe button and turn on notifications so you never miss a real estate educational video. We publish new content every week, so there's always something fresh and exciting to watch. Don't forget to like and comment on this video, and let us know what you'd like to see in future videos. We value your feedback, and we always strive to improve our content based on your suggestions. Thank you again for your support, and we'll see you in the next video.